Welcome. My name is Ryan, and I am a mortgage nerd. Welcome to our stream tonight. We are going to be answering questions that have been submitted through the week, through my Facebook page, my YouTube channel, which is just simply Mortgage Nerd, and nerd is with a 3, kind of a fun little way to say nerd, kind of with a backwards 3. And so it's mortgage spelled normal, and then N3RD on YouTube, on my Facebook channel, and all kinds of different places. But we do have a live chat open as well. So if you have any questions that you'd like to submit, we can get to those questions live as well. And so let me get to a couple that I found here real quickly that we can jump into. Okay, got everything ready here. Okay, so it should be live, should be ready to jump in with any kind of questions, but I got a couple here that I thought were pretty cool. I've got a real estate agent I really like working with. His name is Mike, and he had a great question this week. He says, I have a buyer that is asking if they can qualify for a first-time home buyer program if they bought a home using seller financing. So seller financing is maybe family member or friend or something where you're able to get the seller to just carry the loan or carry the note for you. So it depends on how it was done, but in most seller financing situations, the seller just becomes kind of your lender and you do get added to the title report. So in most cases, you will be on title, which means you're not a first-time home buyer. So, but doesn't mean always. So sometimes there's like lease options to buy, or there's other ways it's structured with the contract and not actually changing ownership of title. Then it just becomes kind of a seller, not seller financing, like a lease option or something like that. So there's a lot of different terminology that's thrown out there. But the idea of a first-time home buyer is not owning or being on title for a property in the last 36 months or 3 years. So you could have owned 100 homes in your lifetime, but if you haven't owned a home for whatever reason over the last 3 years, then you're then reclassified as a first-time home buyer, which just means certain programs can open up, guidelines can be a little bit different. And I've actually had clients that qualify for first-time home buyer programs, but didn't need it because maybe either down payment or credit scores or job history or something else where they didn't really need that designation, if you will. This doesn't mean it's the best loan out there. It doesn't mean that you're missing out if you're not a first-time home buyer. It just is different programs that fit different needs in the marketplace. Just like there's veteran loans or VA loans, doesn't mean you have to do a VA loan, and doesn't mean that there's not other loans you can do even if you have that designation. So part of my job is to review the different loans that you qualify for. In fact, one of the other questions I got here was a good one that was along those same ideas. And it said, what are the advantages of applying for both an FHA and a conventional loan when purchasing your first home? So that's part of my job, is to help limit down or at least tell you kind of what are the benefits and disadvantages of both loans. Because they both have a need in the marketplace. They're both trying to fit kind of a niche. And so they do have little benefits or disadvantages. And we usually can narrow it down on which one's the one worth applying for. It's like FHA, it has the same mortgage insurance regardless of your credit scores. So if you have higher credit scores and you have the down payment, conventional is usually better. Now, if you don't have the down payment, need 100% financing, and do have lower credit scores, FHA is typically better. But so you wouldn't necessarily have to apply for both. That's part of the job of the loan officer, is knowing which loans you'll qualify for most likely. Now, every loan that gets done gets run through what's called an automated underwriter. It checks the application based on the information we put in there and kicks out kind of a yes or no. And then the underwriter's job is to verify what we put on the application. Because we can put anything on the application, but if it doesn't match, say, the pay stubs, or debt ratio is different, or job history is different, or something changes, then that automated underwriter has to be rerun to just check all the boxes once again. But almost every file, as we issue pre-approval letters or get the initial application, will be run through these automated systems, and they will kind of check whether it's an FHA guidelines or conventional guidelines or whatever those guidelines might be. But very rarely do we have to go from, say, a conventional loan to FHA or conventional to FHA or vice versa. We usually have a pretty good idea which one's going to stick before we actually submit it. And that's the benefit of working with mortgage companies, is we'll have an idea as we go through the application, what lender, what type of loan, what documentation we're going to need to gather up. And that's just part of being an experienced loan officer when a client walks in the door, to have a good idea of maybe one or two products maybe more depending on their situation that they're most likely going to qualify for. Then we sit down and say, okay, here's kind of the down payment requirement for this one, the interest rate, the mortgage insurance, all that stuff. We kind of figure out which is the best way to go forward. And usually it's pretty clear. We usually don't have too many times where we're guessing which one we want to do. That's really the pre-approval process, to make sure we at least have that initial approval so then we know where to move on and what documentation we're going to need. Like appraisals are going to be slightly different. An FHA appraisal is different than a conventional appraisal or a VA appraisal. They're going to be different the way we order those things as well. So that was a really good question as well. I had another one I wanted to pull up. And you can add questions into the stream. Let me make sure my chat screen's open up so I can see any comments that come in. But I'd love to earn your business. I'm here in Southern Utah. I lend throughout the state of Utah. I also lend in the states of Nevada. And then I have other resources with other people within the company here at Patriot Home Mortgage. We're right on Bluff Street that we can help you in almost every state. There's a few states you have to have a physical location and license and things like that. But pretty rare that we run across too many needs that are outside of our network of what we can actually do. But me personally, I'm licensed in Utah and Nevada is where I focus most of my business. All right, let's jump back to some more questions. I'll get that out of the way. Okay. Okay, here. So what are the benefits of putting as little money down as possible when purchasing a home with an FHA loan? So again, with FHA, once you hit the minimum down, there isn't any kind of real change in interest rate or change in the mortgage insurance with that extra money down. Now, if you get up to 10% down, the mortgage insurance can drop off after 10 years. But if you put less than 10% down, that 3.5% is what their minimum is, then you have to keep the mortgage insurance for the life of the loan until you sell it or refinance the home. So I would say, boy, in my career, I don't think I've met very many people. I can think of one client in my entire 26 years of doing loans where somebody put more than that 3.5% down on an FHA loan. That's one of its features, is its lower down payment and a chance to kind of buy your first home. That's kind of one of the benefits of an FHA loan. If they have more money down, we're typically looking at a conventional loan because it's going to have possibly better rates, not always, but the mortgage insurance can be cheaper and can drop off after 5 years or a maximum of 10 years. There's some factors and depends on what mortgage insurance company that you use. So it does have a little more flexibility on mortgage insurance if they have the down payment and more likely the credit scores. Because FHA, again, isn't credit score based for the mortgage insurance. It's the same flat percentage no matter what your credit score is. So somebody that has a 620 score is getting the same mortgage insurance as somebody with an 800 credit score. So if you have the down payment and the higher score, we're typically going to look at a conventional loan and not an FHA. So FHA is pretty common. So the question's asking kind of what is the benefit? There isn't a huge benefit with FHA. If you have the extra money down, that's where you start looking at conventional options. One other thing I like to say about down payment is a lot of times putting $20,000 or $30,000 extra down on a home doesn't save you that much a month. I mean, when you hear 10 or 20 grand, I mean, that's a car payment. You know, that's usually a bigger amount on other type of financing when you're dealing with those dollar amounts. But on a mortgage, it isn't as big of a deal. So typically I tell people, let's keep some of that in savings, some of that emergency funds, moving expenses, and let's look at other debts that if we paid that off instead, you would free up your monthly budget, which may allow you to qualify for a little bit more home with the same monthly expenditure. Instead of having a house and a car, now we just have the house, and maybe that'll help you in your brackets or price range, or maybe get the home in the area you want. There's a lot of ways we can use that down payment in more of a strategic way to help you qualify for as much as possible and not just put it all down on a house. The other thing I look at is you can't get that money back without selling or refinancing the home. So if you're giving $100,000 or you're taking the equity and putting $300,000 down on the next house, I often say, let's look at where else we can put that money. Let's also look at maybe keeping that money to make the mortgage payment over the next 10 years instead of just lump summing it all onto the mortgage. But the important thing is to sit down and run those numbers. Many people don't think of that. They just, I sold a home. I made $300,000 on selling a house I've had for 10 years. I'm going to put it all down on the next house. And a lot of times there's better ways to use that money. If you don't have the numbers, if you don't sit and run those numbers and talk with somebody like me that can explain it, then you might just be taking all that money and just putting it in a home. And the home's not going to appreciate or depreciate or change in value regardless of what you owe. Also, you cannot get that money back without selling or refinancing. So if you can just have it in the bank, use it to get rid of other debts, be more strategic with it, I think it's a better way moving forward. They always talk about diversification. You wouldn't put all the money in one gold bar, one stock, one bond. Yeah, you put it all into one house. So when there's other ways to use that money a little bit more efficiently. So I'd love to talk to you about that. If you are trying to sell a home and you need to get to the equity, if you already sold the home and you have that equity ready to go, you want to at least run the numbers and just see if there's a happy medium in between all the money down, keeping all the money. Where's that magic sweet spot? And for everybody, it's going to be a little bit different. Depends on their debts, when they're going to retire, what their income's going to look like. There's a lot of things that go into it other than just getting another mortgage loan. I mean, I love that part of it, is trying to figure out what's a more strategic way to look at this whole thing to be able to help you not just today with a home loan, but maybe 10 years from now, that money would have been better served in investments, in your account, in emergency funds, paying off other debt, all those other things. So I hope that is helpful. Got a little soapbox there for a second, but let's jump into some other questions. If you want, you can jump into questions on the feed, and we can make sure that we've got that live and going. All right. Just making sure that is all going well. Okay. So I posted this to Facebook, which my Facebook channel, I got it on YouTube as well, and just making sure that it's all working. This is a system called StreamYard, and I've been kind of playing with it. Last week was the first week that I did it, and it seems to be working just fine. My camera going well here. Okay. So let's jump into some more questions. Okay, I got too many screens open here, so I can't see that screen and that screen at the same time. Okay, all right. Questions. And I can answer any questions about real estate. I do a lot of questions with credit. That's probably one of the most common questions I get, is how to work on credit, how to fix credit, that type of thing. So if you have questions about credit, I can help you there. And real estate, mortgages. I started doing home loans in 1999. I moved to St. George in 2005. So I've been here now, we're basically July, I think, is my 20th year. So 20 years in St. George. Wow. Well, this place has changed so much in that time frame. But I just love Southern Utah. Just love the climate. Just love the scenery. Just absolutely loved this area. So why am I not getting the right button here? Oh, here we go. Okay. Let's see. This is a longer question. Why would mortgage brokers not simply issue a denial letter, since they can't fully verify my income after my loan was approved by FHA, but the lender is still hesitant to close the loan? Boy, there's a lot going on there. So the denial letters are kind of interesting because of certain laws that we have to do after certain waiting periods that we have to actually show there's a loan denial. So the loan was approved by FHA. So here's kind of a misnomer. FHA actually doesn't loan the money. FHA is basically the insurance company that is housed through HUD that sets the guidelines that if lenders follow those guidelines, they will then have that insurance that then protects the lender. So FHA doesn't cut the check. The lender does. The FHA issues the mortgage insurance that you're paying. So that way, if there is something that goes wrong with the loan, when you're only putting 3.5% down, if the home goes into distress, if you have to use agents, if you have to sell it, usually ends up being a situation where you owe more than what a lender can sell it for. Now, obviously, if you keep that loan 4, 5, 6, 7 years, the longer you keep the loan, the more appreciation happens. You pay down the loan. So that's part of that risk assessment. But FHA actually doesn't approve or loan the money. They set the guidelines that we use to approve it, but we're the ones actually loaning the money and securitizing the debt of that loan, knowing that we've also got the insurance to back the loan. And that's where FHA steps in with certain guidelines that other lenders won't do. They kind of have a little niche that they fit in the marketplace that maybe conventional loans won't do. And so that's part of why an FHA loan even exists and why it's a great option for many people. It's not the only option, not even always the best option, but it's one of the options that's very, very popular for a lot of different people. So there is kind of a misnomer that FHA actually loans the money. They're really setting the guideline for the loan, for the insurance that kicks in for it. That's really how that works. But there's things that can happen all the way to closing. So it's not done until it's funded, recorded. An underwriter can approve it. Loan documents can be at the title company. You could be ready to go. Oh, my light just went off. You could be ready to go, and you could still have loan denial. You could still have something pop up. Maybe there's something happens with the credit report. Maybe something happens with your job. There's all kinds of different things that can still happen. I wonder why my light just shut off. Well, all right. We're just going to have a little cooler video, I guess. Oh, I wonder if I can move my other camera. I don't know why that just shut off. Technical difficulty. We are live, people. This is not staged. This is live. Maybe overheated, maybe? It doesn't feel hot. Oh, hey! I don't know why that shut off. Anyway, so I've seen that happen where people think they're pre-approved. They think that they've got their final clear to close, and they go out and get a car loan. They go out to the Furniture Row and get a $10,000 furniture package or something crazy like that, and all of a sudden their loan gets blown up, and they don't think they're getting their loan. I don't know why that's shutting off, so we're just going to deal with it. We're going to get the light from the camp. Now we're getting just the blue light. Oh, man, brings out my eyes. So anyway, it's communication with the loan officer. You want to talk with the loan officer through this process, especially when applying for new debt, especially later in the process. Now, if you're shopping for your loan, that totally makes sense. It makes sense that you're trying to check with other lenders, kind of check pricing, check interest rates. That's fine. But you don't want to be pulling credit reports for car loans or like store cards. That's probably the most common. Is you'll have something for RC Willey or at like Boulevard Home Furnishing or Furniture Row for appliances or for that type of stuff. And now all of a sudden we have a new debt we have to add to the debt ratio. If that throws the numbers off, you have a new inquiry. So you really just want to communicate with the loan officer as much as you can when those things pop up. We're on your side. We're not trying to hide anything. We're not trying to, we're here to help you with this process, because I often say you're not supposed to know how this stuff works. That's why you have me, and that's why you have your lenders to be able to walk through this stuff to answer those questions. So really it's important to just have that communication, have that trust with the loan officer that you're using to make sure that the process goes as smoothly as possible. So I'd say the two biggest hangups that happen is bank statements and credit inquiries. So let's talk about bank statements real quickly. Whenever we have earnest money or down payment or any funds coming into the transaction, we have to source and season those funds. And so if the money is moved from mom and dad to you, or it's moved from another account to your account, you moved it around, we have to paper trail each of those steps for basically the last 60 days. So that's an important thing you want to do, is talk with your loan officer about where the money is going to come for the earnest money, where the down payment's going to come from. If you're paying off any other debts, if you're moving money around, we can help you streamline that process so it doesn't become a big headache when it comes to that. You also can see issues where people will just send transaction summaries from their apps on their phones. And it's notorious how often we can't use those, because it very rarely even has the bank on there, doesn't have your name, doesn't have the account number, your address, has no way for us to know where this account even came from. So what we have to get is the most recent statement. Then we can get transaction summaries to bridge the gap between the statements. So most banks go from the first to the first. Some will go from the day you open the account, say the 10th of the month, to the next 10th of the month. But most commonly, they're first to the first. So let's say you write your earnest money check on the 10th of the month. What we have to get is the last month's statement that was available, then the transaction summary from the end of that statement, so typically the 30th, 31st, whatever the last day of the month is, through the time it took for that check to clear. So we can bridge the gap between the statements with transaction summaries, but usually not off the apps. We have to get the desktop version because it has a little more information. Sometimes it'll even have the logo of the bank. So this can be a little bit of a sticking point, is getting the bank statements, getting the verifications. And that's where talking again with your loan officer, or me helping you with your loan, I can kind of walk you through some of the stuff. And I often say all this stuff has a man-made reason. All of this stuff has some sort of reason behind it. So if you understand the why, getting the what is a little bit easier. The bank statement, the transaction summary, the homeowner's insurance, the photo ID, the bank statements, the W-2s, the tax returns, the pay stubs, the 1099s, all the stuff we have to get for this crazy thing we call a home loan. And so that's part of my job, And I often tell people, you're not supposed to know how this stuff works. And don't assume. Assumptions kill this industry more than anything, especially when it comes to fixing your credit. I have people make all kinds of crazy assumptions about their credit, and they end up going backwards on their credit score. So that's where getting pre-approval started early, talking with a professional, get your ducks in a row, makes the process so much smoother. And that's where we can help you with a ton of different programs, guidelines, all this fun stuff. All right, let's jump into some other questions. And I do not know why this light keeps shutting off. It doesn't feel like it's overheating, so I don't know. All right. It stayed on the entire time last week, so I don't know why it's glitching out on me. You can post any questions. We can answer those live. You should be able to post either on Facebook or on YouTube. They should pull into my system here where I can answer any questions that you have. And we'll jump into another question. Let me move this over away. Okay. Why would a mortgage lender need a mortgage statement? That's a pretty good question. That's fairly common. So a lot of times the credit bureaus are about 30 days behind or so. There's always kind of behind. Sometimes we catch it right when they report, but most often they're kind of behind because the transactions will happen. They'll send out their statements. They'll send out that report and then wait till you make your next payment, then report that. So oftentimes there is a gap between the most recent due date and the date that's on the credit report. I've seen even 2 months behind in some cases. It's usually about 30 days behind. So they'll still say you're due for, say, May, even though now we're past kind of May 1st. We're heading into May 15th here. And so that's typically what we need the mortgage statement for. Sometimes we need it for the payoff information. So if you're paying that loan off, getting the statement allows us to be able to get the full account number to order the payoff. Also, it'll list if you have taxes and insurance. So say it's a mortgage you're not paying off, maybe a rental property or something like that. We can use that to verify that the payment on the credit report is the full payment on the loan. So the credit report doesn't say if it has an HOA, doesn't say if there's escrows included, it just has a payment for the debt. So there's a lot of reasons we actually need that statement, but I'd say that's the most common. Updating the history, verifying the payment, or helping to get the payoff if we're paying off that particular loan. So that's a fairly common one if there's a mortgage existing. And I'm just not even going to play with that light anymore. It's just off. That is so weird. I don't know. It doesn't feel like it's overheating. I don't know. We got the cool background light on, though. I got that working. Unless you're going to die on me, too. Are you going to die on me, too? Don't do it. And it's even plugged in, I think. Is it just I'm not charging? Is that what we're... I don't know, people. This is live. That's what happens when you're live, I guess. All right. Let's see. Oh, student loans. Is it permissible to miss a payment on federal student loans? So it will show up negatively on your credit if you miss those payments. But here's how we treat payments when it comes to mortgage loans. Even if it's in deferment, even if it's promised to be forgiven, there's all kinds of stuff going on with student loans. The guidelines in most cases, most loans, are going to require that we add some sort of payment to the debt ratio to offset the risk that there will be a payment on that loan eventually. The guidelines typically say 1% of the balance or whatever the payment would be if it was out of deferment. Now, many student loan companies know that we need that, and almost all of them, I have not found one yet that can't get you some sort of letter that said, well, if this was out of deferment, here's what your estimated payment would be. And almost every time, I would say, I only think I've seen maybe one time ever that it was more than the 1%. So usually getting the letter is a lower payment than just taking the 1% of the balance. Now, if your debt ratio is great already, and it just makes it easier for the paperwork, that type of stuff, then we typically can just hit you for that payment of the debt ratio. But I can't tell you how many times people don't disclose student loans or don't say anything about them because they kind of are out of sight, out of mind if they're deferred or going to get forgiven or all this type of stuff. But everything about a mortgage is document, document, document. Whatever you say, you got to verify with a piece of paper because that file moves from us as the lender to the servicer, to a regulator, to FHA, to wherever it's going. So everything has to be documented. It can't just be something you tell me and then I have to wait for a phone call every month or from every regular. Hey, the Johnsons told you what about the file? It's like, nope, it's got to be written, letters, documents, everything has to be in the file because everything has to be checked off. And then that complete file then gets transferred, could get moved, could pop up on an audit. There's all kinds of stuff that can happen with that file. So it all just has to be documented, double documented. So I know lenders and borrowers get kind of fatigued with letters of explanation and all the documents that we need, but there really is a why behind all this. I often say they're all man-made guidelines. They're all man-made stuff. So there's usually a man-made solution. It's just a matter of knowing the why behind it. So then you can get the what a little bit easier. And I can't tell you how many times I've told a client, okay, we need this for this reason. And they tell me, well, I don't have that, but I've got something else that might work. Great. That works too. Most common documents we ask for are the ones that are most commonly used for that condition. But it doesn't mean that's the only way to solve the condition. So again, knowing the why will help both of us get the what that we need for that particular guideline. All right, maybe we'll try to turn on the light one more time. I think it looks okay. What do you guys think? In the comments, does the lighting look okay? All right. Let's see. Can I get a job with an eviction or bankruptcy on the credit report? Depends on the job. There are some jobs that will at least want a letter of explanation. They'll at least want to know if you're currently in the bankruptcy, how that's going to deal with certain things. So it's just part of risk assessment. It's part of reviewing. And if you got two applicants sitting there, one's in a bankruptcy, one's not without one, there may be more of one of the reasons to say yes to this person, not to that one. Eviction depends on how far it goes. Bankruptcy is definitely more public record. It's going to be on the credit report. Eviction, maybe not as much. You have to dig for those a little bit more. But bankruptcy is definitely a part of, again, risk assessment, if you're fit for the job, if you're dealing with finances like banking, that type of stuff, that's where it can be a little bit more difficult when you've had bankruptcies or felonies or these types of things. So it's just better to disclose all of it than trying to just hope they don't find it. And so can it affect your job? Sure, it can. Lower credit scores can affect your job. So that is definitely something that can be a factor. Let me jump. I don't know why that was in this category. Let me make sure I'm in the right category still. Yeah, so it just happened to jump into this category. Let's jump into a couple more here. And again, you can post live. I'll be on for a little while here. And very cool. All right. Let's jump in. Let's go mortgages, see what's in the mortgages tab for tonight. What is the process of applying for positions in the mortgage industry without prior experience? I mean, there's all kinds of entry-level stuff in mortgages. Loan officer assistants are kind of one of those, depending on how they are. So there is definitely positions, usually in processing, usually in clerical stuff. It just depends on the mortgage company. I mean, right now, there's not a ton of those positions because a lot of mortgage companies are running a little bit on the thinner side with hard costs when it comes to that type of thing. But there's entry-level in just about every job, and mortgage is no different. What experience is required to become a licensed mortgage loan officer, or MLO? That's our official title under the licensing, is MLO, or mortgage loan officer. And there really isn't. Now, certain, like in Utah, we have a principal lending manager. You have to be a loan officer for a certain amount of time to be able to get that designation. But no, you don't have to have any prior experience in it to be able to get the licensing. But there is pre-license education you have to take. You have to pass the test, and then that's when you're issued a license. Then your license, you essentially park with a mortgage company that's also licensed, that is then in charge of your license to monitor what you're doing, that type of thing. So it'd be helpful to maybe talk with some loan officers, talk with some other mortgage companies to find out kind of what their process is, and before you get going through the licensing and all that fun stuff. And then every year you renew your license after you do your continuing education. There's state requirements for how many hours you have to do, and then there's the federal requirement as well. So it depends on the state that you're in will also determine how much continuing education you have to do every year. Like for me, there's usually a conference for the National Association of Mortgage Brokers that's down in Las Vegas every year, and they usually have continuing education classes there. So I usually try to sign up for that and get it kind of just one day, get down there, go to the expo. They have a bunch of breakout sessions. It's one of my little business thing I really just enjoy doing. I mean, the expo is great. There's all kinds of new lenders and programs, and seeing kind of an ebb and flow of the industry over the years I've been doing it. And so I really enjoy going down to that national convention every year. It's down in Vegas. Usually it Usually it's Caesars every year is usually where it's at, but it's just good to get the education part of it done. Go down there, spend a weekend around other mortgage professionals, the lunatics that still do this business, and get to hang out with them and get my continuing education done every year. But there really isn't any prior experience you need necessarily, but it's helpful. It's helpful to have some background on this type of thing, but you can get your mortgage license after you take the pre-licensure education and then pass the test that's required. All right. You can ask questions in the chat. This should be on Facebook and YouTube. So if you post a question, it should pull into my dashboard here. So if you have any questions, go ahead and do that. Submit questions. Let's see. Here's one. Why would a lender order a second appraisal? So this can happen on certain guidelines. It can happen if there's any fraud detected. It can happen if it's a non-arm's length transaction. It can happen on certain loan to values. There's a couple different reasons why it can be triggered. Is just, again, it's some sort of risk trigger or some sort of guideline that will require that second appraisal. I see it more often when there's like a non-arm's length transaction or something happening there where they do want a second opinion. Or it can be something where they've detected some sort of fraud or something like that. So it just depends. I've got some questions that are posted here. Is FHA insurance company? Essentially, yes. It's not really a private insurance company. It's a mortgage insurance company, but it's protected under the Department of Housing and Urban Development, or HUD is what we call it. So their guidelines and where their funds go and how they manage their foreclosures. So really, yes, they're really guidelines for lenders and an insurance company, and you pay part of your mortgage payment goes towards their insurance fund that protects when the houses go into foreclosure. Also, FHA typically handles reverse mortgages as well. It's part of the same kind of system. And here's the next question. What's the best and worst part of being a mortgage loan officer? Oh, man, that's a good question. I've been doing this 26 years. You can tell by the wrinkles. So I really enjoy it. There's a lot of problem solving with it. There's all these boxes for guidelines. There's a guideline for everything because everything's happened over the last 70 years of mortgage loans that you can think of. But then something will come out of nowhere, like cryptocurrency. How do we deal with that? What do we deal with ITIN numbers? What do we deal with foreign nationals? What do we deal with? So the guidelines are always kind of adjusting to the marketplace. So there's a real problem-solving aspect to this industry. There's a client comes in with a certain need and they fit most of the boxes, but there might be one or two they don't quite fit in. So we have to kind of brainstorm how we help with that. And so there's a lot of problem solving, and you're dealing with people on some of the most nervous parts of their financial lives. They don't know what they're doing. They're huge mortgage loans, big payments, nervous. I mean, there's a lot of stuff going on a mortgage process. So I get to enjoy that in a sense and go through that experience every single month. I get to help somebody buy a house, which is a nerve-wracking, scary, exciting part of their financial journey. Whether it's the first home, last home, or anything in between, investors, I love working with real estate investors that are buying rental properties or fix and flips. I mean, that's a whole other type of financing that we do. But it is something where that's really the fun part. The worst part about it is we can work on a file for 2 months and never get paid on that. We don't get paid till the loan closes. And we don't get any kind of, salary or anything kind of on that until those loans close. So we're really kind of live and die on the interest rates a little bit, the market. You always have to be working on every part of your pipeline. But it seems to happen, you'll kind of be working on the origination, getting a bunch of applications, getting them through underwriting, closing them, and kind of starting over. So I found through my career, as long as I can be touching files in every stage, it keeps it a little bit more consistent. But in the end of the day, it's really a sales position. And it's going to have ebbs and flows. It's going to be highs and lows. It's going to be underwriters that say no and clients that don't want to get their paperwork to you, and meeting expectations and dealing with real estate agents and just their part of this whole thing, and dealing with title companies, insurance companies, appraisals. I mean, there's a lot of moving parts on this thing. And often I feel like the loan officer and the real estate agent are kind of the hubs of all this thing. And so they're always trying to work on making it happen. So there's, just like any industry, there's going to be kind of highs and lows. Right now, we're in kind of a lull. Interest rates have been a little bit higher than they were. I mean, they were just giving money away for years. And now that rates are a little bit higher, people are more picky. Refinances have dropped off like crazy over the last 2 years, which was a huge part of the business there for about 2 years, 3 years or more, was a lot of refinance business. That's just basically gone. Has been for quite a while. So much more of it's focused on purchase business, new construction. So if you're not working and kind of flowing with where the market's going, you can be left behind really quickly. But I really enjoy it. I've done it for a long time, 26 years. I don't know what else I would do. It's just what I do for a living and really enjoy it. I enjoy it much more than I hate it, but just like any job, it's got its benefits and disadvantages, but I really enjoy it for the most part. All right, let's do some more questions here. How are we doing on time? I usually do this for about an hour or so. I might go a little longer tonight. Hopefully you're seeing this on a few of my different posts here. Okay. Ooh, this is a deep one. Can I inherit my deceased mother's house if it has a mortgage? So yes, the mortgage is just the collateral for the loan. So it's the house is the asset or the collateral. So you can't inherit the ownership of the home. It doesn't mean the mortgage just goes away. It's still tied to that home. So you can't inherit it. Typically what you have to do is either sell the property and take the difference between what you owe on the home or what's owed against the home and what it's worth. But you do want to set up a trust, because if you just inherit the property or add it to title, then you'll be paying a capital gains between the difference of what you sell the home for versus what your parents first bought the house. So if they bought it for a sandwich and a handshake 50 years ago, and now you sell it for $400,000, you're going to have 25% that you'll owe in capital gains. Where if it's in a trust, when they pass away or go into assisted living or you're assigned that asset, you get what's called a basis increase. So you get to go up to the market value of the home and not have to worry about the capital gains. Unless, again, you keep it after that triggers and you keep it for a while, then there can be some capital gains that kick in. But that's where an estate planner is really, really crucial. Now, parents out there, don't just add your kids to title. Everybody thinks, well, if something happens to me, you'll at least be on title. Again, that's great. It's better than not doing that at all, but it doesn't avoid probate and doesn't avoid the capital gains on the house. You want to set up a trust. There's a guy that I know in town, and make sure I have his website correct. He's really good with trust, very cost effective. I want to make sure I have his website correct. I think it's easy. Yeah, there it is. EasyLegalPlanning.com. His name is Jim. EasyLegalPlanning.com. Very cost effective. People are scared that these things cost thousands of dollars to do. I mean, they can, depending on how many assets. If you're moving from a different state, I mean, they can be expensive, but most of the basic trusts are less than $1,000. I think he's in the $800 or less range. And I'm telling you what, just the savings on taxes alone is worth getting it done. So if you've been putting it off, here's a public service announcement. Get your trust in order. Do not just add them to title because you think that's the right way to do it. Because they will owe 25% of your appreciation in capital gains when they go to sell the house. Why? They don't have to do that if you structure it correctly. So get your estate planning done. Get a trust. Do it now. Call Jim. Let him know Ryan at Patriot Home Mortgage referred you. He'll take incredible care of you. Very busy guy, but I tell you what, public service announcement done. Get your trust. All right, what else we got here? Any other questions in the live feed? Let me check that. Boy, the lighting's, I'm going to try the light again, maybe. Here we go. Oh, holy moly, that's bright. Okay, now I'm being interrogated. I don't know where the bank statements are. Okay. That's a dumb joke. All right. Is it mandatory to buy property insurance with a home loan for the building that is under construction? Yes, there is cost or course of a construction insurance that is a different type of insurance that does cover the insurance. In fact, that's probably when you want it even more than when the house is totally done, because you're going to have subcontractors coming on there. You're going to have more chances for stuff to fall and break and hit somebody. You've got some kids running around the yard and they fall and trip into the basement, or they do. I mean, so that's probably the insurance you want the most, because that's when you have more of a chance of liability is during the course of construction. So if you're trying to save the money on that, I mean, and it's so inexpensive in relation to what it covers, because it is lower risk. It is something where homeowners insurance for the dollar amount it protects is actually really, really cost effective. But it's definitely during construction. You don't want to skimp, if you will, or you don't want to That's where you really do want that coverage. Because just think about it, there's how many different contractors are showing up? How many different, you got all this exposed timber and wood and roof. And I mean, what if the neighborhood kids just roll up on their dirt bikes and start playing war with dirt clods or something in your house and just been poured the concrete slab and one of them trips and falls, breaks their leg, family tries to sue you. I mean, you do want that insurance. Just don't skimp out on it. And it's not typically crazy expensive in relation to what they're insuring. Now, in relation to something else, maybe it is, but usually the coverage of that is very cost effective for how much they're covering. So is it mandatory? In most cases, yes. If there's a loan, they're definitely going to want it. But if you don't have the loan and you're just kind of paying for it as you go, then maybe you don't need it, but you want it. Just get the insurance. It's not worth it. Let's see. I make $80,000 a year. Can I buy a $300,000 house? Maybe. So there is. I get this question a lot. How much do I need to make to afford X house? And it's not just the mortgage loan that we factor in. So if you have $80,000 a year and have no other debt, no problem. But if you have $80,000 worth of debt and have $5,000 a month in car payments and student loans and visas and all this stuff, then you'll need to make a lot more income. So it's not just the mortgage that's part of the debt ratio factor. It's the other debts as well. And it depends on how you make that $80,000. If that $80,000, you just started a new job, or you just started self-employed, or you're just 1099, or that's your gross income on self-employed, but you write it all off. So that's part of my job, is to sit down and say, okay, what income did we claim? What can we use? What the debt ratio is, both the debt ratio with just the house, the debt ratio with all the other debts, what loans do they qualify for? But so that's why it can't just be a yes or no answer, because there's more that goes into it than just I make X amount, I want to afford X amount on the mortgage. There's other factors that go into it. What's your down payment? Is there an HOA that's part of the payment? What are the taxes and insurance? What's the use of the home? There's a lot that goes into it. And that's why when clients call you and say, what's the rate? It's like, well, there's so many things that factor into the rate that you will actually get, that the rate you see on a billboard or an advertisement, you got to realize, just like car loans, they're going to advertise their best possible rate that maybe 5% of the population ever really get. They're advertising some of their best possible lowest interest rates. And my job is to be able to say, well, yeah, you have 40% down, 900 credit score, 40% debt ratio, primary residence, rate and term refi. What is your scenario that determines the rate you will actually get? And that's part of my job, is to show you the differences between those two. All right, see if there's any other questions. You can jump in and comment there. Hopefully that's working. I got a couple comments so far, and there the light goes again. All right, I give up. And it's not even getting warm. I really don't know why. You're just turning off, you quitter. Why are you quitting on me? Oh well, makes it more real, I guess. But don't go out on me. All right, here we go. We have not fully paid our mortgage, but if we sold the home, would we get what we paid for, or could there be an increase in value due to home improvements? Doesn't matter if you have a mortgage. Like, what the home is worth has no bearing on what you owe. Now, hopefully you owe less than what the home is worth. That's the idea. Even the lender doesn't want to get upside down. But it doesn't. We have not fully paid our mortgage, but if we sold the house, would we get what we paid for, or could there be an increase? Yes. So the value is not going to really be based on the mortgage. If it's improved in value, once you pay off the loan, you keep the difference. There isn't something where, well, now I got to give that back. And what you paid for it, maybe, it depends on what you paid, if you overpaid for it. I mean, there's a lot of little moving parts on this, but I think there is a misconception that once you get the mortgage, that the mortgage company owns the house and you can't sell it because you have to have the house free and clear to sell it. So it really doesn't work that way. So when the new buyer comes in, their money, whether they pay cash or they get a new mortgage, pays off the debt on the property. Whatever's left over goes to you, or goes to commissions for your real estate agent, or title insurance, or all those things get factored in. So you do want to sit down with your agent if you're going to list it, or talk with a mortgage company. We can give you what's known as a net sheet that says, okay, based on this sales price, based on your first mortgage, your second mortgage, your property taxes, whatever you owe, this is what you're going to net after that. Then you may have capital gains depending on the use of that property. Now, if it's been your primary residence where you've lived in it the whole time, then there usually isn't capital gains. It's only if it becomes a second home or an investment property where you have some potential for the capital gains. But I have seen a lot of people think, well, I got to wait till I have it free and clear before I can sell it. And that's not the case at all. Now, to be able to sell it, you have to owe less than what it's worth. Otherwise, you got to bring money to the table. So depending if you just bought it this year or 6 months ago and you have to sell to relocate, you may not have a lot of room depending on what you put down. But once the sales price kind of covers the mortgage, whatever's left over goes to you or your trust or family members. There's lots of things on this question, and I've seen people say, well, I want to be able to get a second mortgage, but I got to get rid of the first. So to talk with me if you have questions. If you really do have some serious questions, very specific questions, that's what I want to be here for. You go to my website at ryanbolton.com and you can get my phone number there. You can download our mobile app. We've got mortgage calculators on there. I put blogs on there all the time trying to add content for SEO and all that kind of stuff. In fact, let me do this real quick. I'm going to pop this up on the screen here. This is the mobile app that you can download. It's got my website there as well, but you can take a screenshot of that or use your phone for a QR code there. They'll allow you to download the mobile app that has really easy, quick calculators on there. You can apply for a loan right there. You can reach out to me, message. There's all kinds of stuff that are built into that app. And then, of course, ryanbolton.com. Just my name, normal spelling, Bolton, and I can get back with you on any question that you have specific, or you can post it here on the chat. So I'll leave that up for just a second here while I find a couple more questions. This one's a fairly easy one. Let me drop this out of the way here. What will happen if you submit your documents to two different banks for a home loan? Nothing. They both pull credit. You can get pre-approval. Part of shopping is maybe you don't have to get to the point where you're submitting both to both companies. That's part of shopping for a loan. Now, here's a couple things I would say about shopping for a loan. We all follow the same guidelines. We're typically all getting the money from the same sources. We're following Fannie Mae, FHA, VA guidelines. So you're not going to see a huge difference when it comes to guidelines between mortgage companies. What you're going to see differently is accessibility, answering the phone, answering your questions, getting things done promptly. Those are the things I think that really separate mortgage companies, not so much rates and terms, because we're all getting the money from the same sources. Every day I get 50 rate sheets from all the lenders out there, and you don't see a ton of difference because they're all checking everybody. They're all kind of securitizing. They're all funding the loans in very similar channels, so you don't really see a huge difference on that. Now, loan officers get compensated differently based on a percentage of the loan. So loan officers do not get paid based on selling you an FHA or a conventional loan. There's no bias or what they call steering or forcing somebody into a loan because you get paid more on it. The only way we get paid more is higher loan amounts, really, because it's a percentage of the loan. But trying to convince somebody to take out $50,000 more doesn't really make a huge difference because we're usually talking 0.5% to 1% is what we're talking about. So they really got rid of those incentives after the 2008 crisis. A lot of guidelines, lending guidelines, disclosure, so many things changed after that. And that was one of the big ones, is not steering people towards loans that made the mortgage companies more money. That's why subprime loans really ramped up, as they paid better. So if they're kind of on the edge of what loan to do, or stated income, or some of these loan programs back then, they would pay more. So there was this tendency to steer loans that into those types of pipelines. But it was pretty rare, and most of the people that are doing the steering, they weren't in the business very long. That's part of just these ebbs and flows of our industries. It kind of gets rid of the bad apples, if you will. But there definitely was some of that, and that's why mortgage companies and regulators really changed how the industry works from this point. But it is something where if you submit your documents to both, you probably can limit it down before you have to go through that process, because you've already gotten quote on rates or quote on fees, or got to know the loan officer a little bit more, had that rapport. That's really, if you spend a little more time on the front end, you usually don't have to send to two different banks. Because again, they're following the same guidelines. So the guidelines down the street are not going to be typically much different than what I have. Now, there's going to be niche little programs. There will be stuff that if you're not wage earner, or you're self-employed, or you have different types of income verification, maybe they'll have a little difference, but it's usually not the biggest difference with mortgage companies. How are we doing on time? Let me take a quick look. Okay, we're doing good. You can jump in, ask any questions, post on there, and it should feed in here to where I can see it. I got a few people watching, maybe if you could just say hello, then I can see if the chat is working. So if you're watching, go ahead and say hi. Hello, how are you? Thanks for watching. I appreciate you being on. If you have any questions, credit, real estate, first-time home buyer, all that stuff, that's what we're here for. What happens if a loan against property, is not paid? Well, again, the mortgage is the collateral, the home. The home is the collateral for the loan. So if you don't make your payment, they take back your stuff. So they don't own your house. You don't rent it from the mortgage company. I think that's just a funny term. It's the collateral for the loan. If you don't make the payment, then they take back the collateral. Now, in most cases, every state's a little bit different, but almost every state requires that you send out a notice of default, and that notice of default gives you 90 days to reinstate or replace or sell or replace that loan with a new loan that's in good standing. After that, there's usually more public notices they have to do. Then they actually get to go to auction and try to sell your property. If nobody shows up at the auction, then that's when the mortgage company actually gets the property. So that's pretty simple. That's a simple version of what happens. There's a lot of steps in between, but there's typically this notice of default, what we call NOD, notice of default, that triggers and starts this process. Now, technically, if you're more than 30 days late, they can start this process. But I'd say most mortgage companies get to 60, 90 days before they start doing the notice of defaults. And that's where you should reach out to the lender and see if they can help you with whatever's going on, like whatever's causing you to be late. Maybe there's a death in the family, medical illness, maybe job loss, maybe something has happened where they can work with you on either lowering the payment temporarily or do a forbearance plan, or if it is just better to say, hey, we're going to get this home on the market, we're going to get it sold. As long as you cover the balance on the mortgage, you still get to keep the difference. So even if they start the foreclosure process, let's say you owe $400,000 on the house, it's still worth maybe $450 or $500. You would get the difference still, even in a foreclosure. The downside with foreclosures, you're now starting to add late fees. You've started to add interest. You may have a default interest rate. Maybe an attorney's got involved. So you're going to have that balance creeping up pretty quickly. So the sooner you can get on top of that, the better off you're going to be. Because we're not in the business of foreclosure. That's not what we're trying to do. So we usually have some programs to at least help or temporarily band-aid it. But other times, yeah, the foreclosure process is going to go through. It's a natural part of lending on loans, and stuff happens. People lose their job. People get injured. Deaths. There's all kinds of stuff that happens. And that, in fact, if there's not enough foreclosures, there's a sense that maybe we're being too tight with our guidelines, that we do need to loosen up a little bit to give more people a chance to get into a home loan. Because if there's no foreclosures, we've taken on no risk. That means we've said no to a bunch of people that were probably worth at least a little bit of risk of foreclosure. And so it's actually almost unhealthy not to have some foreclosures out there. Because even in the perfect market, perfect guidelines, there's still going to be stuff that's going to happen where people get foreclosed. But there's a lot of consumer protections to give you a lot of time to make it right, sell the property, whatever you have to do there. So the question is, what happens if I don't pay? Well, no pay, no stay. Eventually, they're going to take back the collateral. Got a couple more hellos. Hello. Thanks for watching. All right, let's see what else we got. This is probably one of the most common questions I see online, or some version of this, is, can someone with poor credit get a home loan? The answer is maybe. I would say in most cases, yes. There's people that are willing to loan to any credit situation that's out there. Usually it's more money down. Usually it's higher interest rates. Usually there's other reasons. And I often say, why is the credit poor? What can we do to fix the credit? That's worth the effort than just taking whatever loan we can get you into. Now, there's going to be some times where if it's so poor, it's just going to be a no, flat out. Because usually it's poor for a bunch of other reasons. No income, no assets, no down payment, no job history, and poor credit. It usually compounds a lot. when we have lower credit scores. But it's an amazing amount of stuff you can do to get somebody to the tier where you can do 100% financing. You don't need 900 credit scores to get 100% financing. If we can even get you to 660, which isn't crazy hard to do, you can get into 100% financing. But knowing why your credit is the way it is will help determine what to do to fix it. And the sooner you start the pre-approval process, the sooner you're going to be ready to get into home ownership. So many people that have bad credit have just ignored it, buried their head in the sand. They've waited years. They had lates they didn't worry about. They turned in a internet box or a cell phone, and there was a past due bill, and they didn't want to pay it. I mean, there's all kinds of reasons, and there are bad companies out there too that take advantage of people. So I'm not saying it's all on consumers, but more so often they exaggerate or make it worse on themselves and just trying to deal with it at that time. And then 2 or 3 years go down the road, and they always, every time they pull their credit, they have to explain the stupid thing they did when they were a kid with their cell phone bill or whatever it was, and they just haven't dealt with it. And I'm telling you, I've helped so many people with their credit because I can tell you, okay, this is why your score is the way it is. Go fix A, B, and C in this order. You will see better scores. I can't tell you how many people start working on their credit and do it wrong and actually go backwards a little bit, then start to go forwards. So there's a right way to do it as well, so you don't go backwards. Or if you do, it's very, very small, not a huge step back, get discouraged, and then you're just give up on buying a house. And I will also tell you, I've told people so many ways to fix their credit. They get all excited, they leave, and they do nothing for 6 months, call me up and say, hey, I found this house, or my lease is expiring. Hey, now I really need to get working on it. Pull their credit, and it's the same. I mean, it's just like, you can't force them to drink. You can't make the horse drink kind of thing. But I still like to give the advice and show you how it works and be specific to your situation to make sure that you are maximizing your credit report, because it leads to so many other things, whether it's a mortgage, a car loan, homeowner's insurance, jobs. So many things are tied to credit. And if you're not working on that or know why the score is the way it is, you're going to hurt your financial history no matter what. That's what credit is. It's a report card. It's a credit history, not a credit today. And I had so many people that have buried their head on their credit for 3, 4, 5, 6 years. Then they get all gung-ho for 30 days to do something about it, and like they get disappointed. They get detracted. And it's sad. It's sad to see that, but there is a path. There is a way to get it fixed. I can help you with that. Love to help you get your scores where they need to be so you can just have better credit. Whether it's a mortgage or anything else, fixing your credit is well worth the time. Another soapbox. I need a soapbox counter window. That might be number 3. Yeah, it's probably number 3 today. All right. I like doing this. It's fun. Here's that same question. How much house can I afford if I make $30,000 a year? That's going to be tough. $30,000 is, I don't know, what's like the poverty level, or it was like $24,000 forever. I haven't even checked that for a while, but especially in our area, $30,000 is just not going to buy very much. Now, is it impossible? No. But it depends on the other debt. So if you've got $30,000 and a $200 a month car payment, that just wipes out your debt ratio. So $30,000 is pretty difficult. And what we typically will do is we will take your income divided by 12. So it's a monthly amount. Then we typically will take that by 45%. So whatever your monthly is, 45%. Then from there, we minus out all the existing debts on credit, car payment, Visa, student loans. This won't take into consideration like cell phone or internet or certain other types of utilities like life insurance, health insurance. Doesn't factor those things in, just anything that's other debts on the credit report. Now, it can't go higher than that 45%, but that's kind of a good rule of thumb to kind of start there. If you have higher down payment, higher credit scores, or more money left over, that debt ratio, I've seen it go as high as 60%. So just there is some factor in there, but typically if we're right about that 45% mark, that's a good rule of thumb of what price range to shop for until we actually gather up the actual application, that kind of thing. But simple math, you take your yearly amount and you divide it by 12, take that amount, times it by 0.45 or 45%, and then add up your bills. Whatever's left over, that's the most the mortgage payment can be for. So let's talk about mortgage payment. Just like a car loan, you're going to have the principal and interest on the loan itself. But the other things that get added to a mortgage are going to be the yearly property taxes and the yearly insurance. Same thing as the income. We take whatever the yearly amount is divided by 12 and add that to the mortgage payment. That way, when you make your mortgage payment, you're covering the renewal of the insurance and the yearly property taxes. Now, some states have it more than once a year. In Utah, it's once a year every November that the property taxes are due. And I would say 90%, maybe more, of Utahns have an escrow account, at least for the property taxes. Then you might have to also add mortgage insurance, depending on if you're putting money down. So that's another factor that adds to the mortgage payment. And then if there is a property with an HOA, so if it's a townhome, a condo, or in some sort of community where there's an HOA, you also have to add that to your debt ratio. So it's not just mortgage payment, it's those other things that you want to calculate to make sure that, if you want to spend $2,500 a month, you got to back those things out. Because if you set the mortgage at $2,500, when it's all said and done, it could be $3,200, depending on if all that other stuff gets added on top. So that's part of my job, is when a client says, well, I really want to afford this, we kind of break down, okay, let's back out kind of a guess on taxes and insurance till we nail down a house, maybe back off the HOA, just to make sure that the price range I'm quoting somebody is within kind of a tolerance to make sure it's not going way over that number. And it's hard to nail it all the way down until we do pick a home, because some of those numbers can fluctuate a little bit, and interest rates can fluctuate a little bit. So it is something where it's part of my job is to give you the most accurate quote we can while you're actually shopping for a home loan. So I hope that's helpful as well. And that's where I get you a free quote, free review, free pre-approval, all this stuff we do up front to be able to nail this down for you, because even we don't know what we can do yet until we've started some of these processes. So that's why there's no cost up front. There's no obligation. We're just in the information gathering stage, and that's where I can help, is nail down exactly what you qualify for, how to fix your credit, how much money down you need, what other ways we can get you the best possible loans that are out there. That's my job, and that's why I enjoy doing it. All right, how are we doing on time? Let's just keep rolling here. You can jump on anytime if you have any questions. Let me make sure. I just want to make sure this is shared too. Let me just do that real quick. But you can comment if you're on. You can jump there too. Let's just see. I want to make sure this is posted. I think it should be live. Oh, hey, look at that. I'm live on my own Facebook. Looks like there might be a hair delay. That's kind of fun. Okay, I can see myself on both the StreamYard screen and the other one. Well, I tell you what, I don't know how long I lived my life with like one screen, like a fairly bigger screen, but getting two screens, oh, it's life-changing. No, that was a boomer comment for sure. All right, let me just check one thing here real quick. Sorry. I need like a commercial break right here just to be able to mess with stuff. But we're live, people. We're just having fun, answering questions about credit, real estate, mortgage, all that stuff. All right, let's see if there's any comments here. Oh, yeah, they show up on there. That's cool. Okay, all right, let's go back to questions. And if you don't catch this live, I'm still reachable. You can reach out to me anytime. Check out my website at ryanbolton.com. In fact, you know what? That's what I should do is I'm going to throw this back up here while I'm messing with some questions. So there's the QR code to download the app. My website, just ryanbolton.com. Love to earn your business. I do lending in Utah and Nevada. Okay, all right. Found a couple more here. Let's leave that up for just a second longer. And again, you can post any questions on it should be either on YouTube or Facebook, but I believe any question on either one should just pull right into my dashboard here so I can see it. So you can jump in and ask any questions. Oh, where did my screen go here? Okay, here we go. I'll pull this down again. Here we go. All right. If a house is in foreclosure, can you pay the past due amount to stop the foreclosure? Absolutely. In fact, that's what the notice of default is basically saying is, hey, you're in that stage of foreclosure. If you catch up the payment, reinstate the loan, you'll be fine, or pay off the entire loan by selling the property, replacing it with a new loan. But absolutely, that's part of your consumer protection, that if you can catch up the payments, pay late fees, late charges, possible attorney fees, if you can catch that up, then you can reinstate the loan and everything's hunky-dory with that loan. That doesn't mean it won't hurt your credit because there'll be 30-day late, 60-day late, 90-day lates on the credit, but you can recover from that. So I've seen that happen a few times where somebody loses their job, they start going into foreclosure, they get a new job, they're able to catch up the payments. Great. So they took that hit for a couple months, but absolutely, that's what the notice of default period allows you to do is reinstate the loan. So there's consumer protections that absolutely allow you to catch up the payment. I am 60 years old with a $380,000 mortgage. What should I do? Keep making the payment or you lose the house. You can look at a reverse mortgage. So this is where you can get, possibly depending on your equity, that type of stuff, you can look at a reverse mortgage that could pay off that loan and have no more payments. You can sell the property, downgrade. So obviously there's not a lot of context to this question, but it is something where as you get to a certain point, cash flow matters a little bit more than a whole bunch of equity you can't get to without selling or refinancing. So that's where some reverse mortgages start to kick in. He's 60, so he has to wait till he's 62 for a reverse mortgage in that case. So maybe it might be worth selling it, downgrading, or keep making the payment. It might be the best payment you're going to have for a housing expense because you typically are going to have a housing expense no matter what. So it depends on how long that loan's been out there, but keep making the payment. Let's see if there's any questions posted. Okay, we're looking good there. And sorry, my little light went out here, so I don't know what its problem is. Quitter. It didn't even feel like it was getting that hot. That's what I don't understand why it would just shut off like that. That is weird. It was on the entire stream last time and then just gave up on me. I might have to try a different light next week. All right, let's see. I've worked 1 year at my second job. Can I use this income to qualify for a mortgage? Typically, no. Most guidelines want to see that you have a likelihood of continuance or that you had that job for 2 years as a secondary job. There are some exceptions. Let's say you're a nurse and you work for Dr. A and Dr. B and they both pay you a W-2. So you're in the same office or the same kind of industry, the same hospital, but you're getting paid from different sources. So there can be exceptions to that. But in most cases, they want to see a long track record or history of being able to maintain 2 jobs. Because typically you'll have one that has 40 hours, maybe one that's 20, and that's a lot of hours, and it ends up being very seasonal, or you're only doing it, or delivery driver. That's probably the most common one I see, something like a DoorDash or some sort of extra job that they want to be able to use that income. And typically with only 1 year, no, they're going to want to see a 2-year history with that. There is exceptions, but I would say generally you're going to have to wait longer. This also applies to things like child support or award letters or alimony or anything that we can't show will continue for more than 3 years. So with child support, if the kids are over the age or at 15 or older, we typically can't use that child support income because it won't continue for 3 years. And we want to see a 12-month history that what's owed on the divorce decree is actually being paid. Because let's face it, a lot of people owe child support that don't pay it consistently or miss payments until they're like garnished or ORS takes over or something like that. So unfortunately, the history on that can be pretty spotty. So when it comes to that kind of secondary income sources, there is guidelines for it. And the most common guidelines is proving it'll continue for 3 years and the payments have been received for the previous 12 months. Those are the 2 major barometers. There's exceptions. There's ways to be able to make it work, but almost everything's going to fall under those 2 guidelines. And I usually see one of the others going to be an issue. Either the kids are older than 15. And I'll have times where it says, well, in the decree, it says that or until they're graduated, even though maybe they turn 18 before they graduate, or they're even going to college. But almost every guideline is going to kind of stop at 18 years of age. So we have to be before they turn 15 to use that income. And really, I would say that usually is income that's designed for the kids. It's designed for expenses. And so using it to qualify for the mortgage can be a little bit sketchy too, because if it doesn't get paid and now you relied on that to make the mortgage payment, now all of a sudden you can't make the mortgage payment. Now you're put into a bad financial situation. So, if you can qualify without it, I do recommend trying to go that route, or just make sure that it is very consistent, that it's going to last at least that long. Because even after 3 years, if that income goes away, can you make the mortgage payment? If it really comes down to where, no, I really need that to qualify, then you may need to back down just exactly what you're trying to qualify for. But you know your finances better than I, but I mean, those are things to consider and how the lender is going to look at that type of income. Let's see, any questions here? Let's make sure I didn't miss any questions in the feed. If I buy another house as my primary residence and rent my current home, will my new home have a primary residence mortgage? Yes. So when you first buy the house, it's the intention at the time of the house. So let's say you've owned the home for a year, maybe 2 years, and you want to turn that into a rental or a second home and go buy a new primary residence, no problem at all. Now, occupancy is the number one fraud in our business because you get better rates, better terms, because the risk is lower to a lender. If you have a rental property and you have your primary residence, if you miss your job or lose your job or something happens, what payments are you going to start missing first? Most likely the rental property. Or you've also got a renter in there. Maybe they trashed the place, they moved out, you can't find a new renter, you start missing payments. So rental properties have a higher risk. So primary residence financing does give better rates and terms. But that doesn't mean that once you buy a home with primary residence financing, it has to stay as your primary forever. So you are allowed to be able to move it. Now, most lenders want to see at least 6 months to 12 months as a primary before it becomes an investment property, unless there's legitimate reasons. Like I had a client who moved to Southern Utah and like 2 months later got an incredible job promotion but had to move. So he ended up moving and buying another primary very quickly. But it made sense. There was documents. It wasn't something where it was planned at the beginning. He wasn't trying to beat the system or commit mortgage fraud or anything like that. So there's times where there's exceptions to that. But generally speaking, they want to see that they loaned it as primary residence. It is your primary residence for that waiting period. But after that, you can turn it into a rental, sell it, do whatever you want to do with it. In fact, I still have 2 homes that I once lived in that now are rental properties. It's a great way to kind of also build an investment portfolio, is to start as primary and then upgrade to another house and keep the other one. Now, not everybody likes to be landlords. There's pluses and minuses with being landlords, but I think there's more plus in the long term than there is the short-term negative of the properties. But short answer to this question is absolutely, you can have a primary residence loan on a couple different properties as long as you did move in and they really were used to acquire a primary residence at the time of the loan. After that, you can do as many as you want. Now, a couple things as well when it comes to how many homes you can have financed is there's guidelines between 1 to 4 financed homes. Then the guidelines change from 4 to 6. Then there's a guideline change from 6 to 10. There's even a few kind of in between those. But once you get to 10 finance properties, that's where you can't get Fannie and Freddie type loans anymore. So what I've done for some of those clients is we refinance a couple of them, maybe consolidate a few of them into one loan on one property and make a few of them free and clear, so then you can free up the money and roll it to the next property. Or we just have to put enough money down on the 11th property where you don't need Fannie and Freddie financing, which there's lenders out there, they're just a little bit more limited. Rates and terms are going to be worse. So that's the most common thing. When you get kind of a big portfolio of properties, there's ways to structure it to still maximize the leverage, get the tax benefits if they're still available. I mean, there's some limitations when you have that many property and that much mortgage interest you're trying to write off. But that's just part of my job too, is when somebody comes in with a portfolio, we kind of, what's the best way to make this work? I tell you what, those are pretty fun loans, is when you're trying to again, problem solve on how do we maximize interest rate, down payment, cash flow, all of those things to help with real estate investing, which is a really fun part of mortgage financing. So that's what I do. I help everybody that's the first time somebody's bought a home to the guy that's bought 100 homes, or upgrading, or investors, or private money lending, or bridge loans. I tell people all the time, I sell money for a living. I sell money for real estate, and I can help you with so many different ways to get this done. All right, how are we doing on time? We've hit we're just over the hour mark, an hour and 15 minutes. All right, we'll keep rocking and rolling here for a little bit longer. So I just reshared it as well. Oh, okay. Let's see. Make sure I posted that to the right place. All right, let's jump into more questions. If you have any questions, you should be able to post them. They should show up here on the little dashboard I've got. I'm using a StreamYard, is what's called StreamYard.com. It's been a great little platform. I've kind of been playing with how it works. I tried this last week and sent out the wrong link. So this week, I think I got the right link going out to YouTube and Facebook. Oh, I got somebody questioning. That's a little antler that I got up in Alaska. So it's, in fact, don't want to pull this out. check this out. It's kind of a little antler that was carved into a little eagle thing. That's what that is. So somebody's asking what's that on the top of my desk. I just thought it was kind of cool. I think it had there's like a date and everything on the back of it. So I was on an Alaskan cruise a couple years ago now, and this thing I just thought, oh, that's cool. It's got a little eagle and a little antler. It's kind of cool. Yeah, I got some other stuff. We had some property. Ooh, I don't know if you could hear all that. I was too far away from the microphone. This is what I got from in Alaska. Oh, there's the. Ooh. Yeah, it's pretty cool. So just at the top of my desk there, somebody was asking about that on the feed, and then there's over here. This little Lake Tahoe thing. I've got some Alaska stuff. This is the Masters. I used to play a lot of golf. Got to reverse everything. And then the little Hawaiian dancing girl, got that in Hawaii. And anyway, so that's some of the stuff here in my office. Thanks for the question. All right, what else we got? Here we go. Can someone with bad credit? That's such a common question. And I always say, let's work on the credit first. There's ways we can get your credit up if we know why the credit score is the way it is. But can someone with bad credit have their parents co-sign on the home loan when applying for mortgages through banks or mortgage brokers? Yes, but whatever the lowest credit score is, that's the tier of the interest rate. The mortgage insurance always is going to be based on that lowest credit score. So you could have, your credit 500 and your parents are 800. They're still going to use that lower credit score. So it doesn't get around it, but typically co-signing can help with debt ratio, down payment, job history. It can strengthen the file for sure. That's why we have co-signers, but it doesn't get around the credit score thing. You still have to have the minimum credit score required. But you could have no income, no asset, no down payment. It all could come from the co-signer, and you'd still qualify if you've got at least that minimum credit score. So that's just one you can't get around, or you can't offset it with more positive credit scores. So let's say you have 10 borrowers, 10 people on the loan, and everybody's an 800, but one person is down on the lower. That's what credit score tier, that's the guidelines. That's what's going to require on the interest rate, mortgage insurance. All that's going to be based on that lowest credit score of all the borrowers that are on the file. All right. Any other questions? Let me just throw this up here as well. So you can check out my Facebook page, my YouTube channel. I've got all kinds of Q&As on there. I've got a podcast that I do. Got a lot of these Q&A type stuff. I've got topics on there, all kinds of different things that I've done. I create a bunch of reels. I've just had a lot of fun just even learning how to create all the content for all this stuff. And just so that's kind of a fun little slide there. And then here's just kind of my team. I've got a loan officer assistant, Luvia, that's just amazing. And she's just awesome. So I really enjoy working with her. She helps me just with getting paperwork ready to go, push it through processing, underwriting, and just I run my jokes by her all the time, and she laughs at some of them. Not all of them, but some of them. And then here, it'll pop this one up too, RyanBolton.com. So the QR code is for our downloadable app that has great mortgage calculators, my contact information, scheduling appointments, filling out the application, getting started there. That's where we have a lot of people start with doing the actual application. So you can go to that website anytime you want. But you can post a question on the stream here. We'll get to those. Let me jump to a few more here on my screen. But you can jump in, ask any questions about credit, mortgage, real estate, financing, all that stuff. So let me go back to, let's go into a different category here. Let's go mortgages again. Okay, what happens if an ex-spouse doesn't pay their share of the mortgage and leaves it up to you? Boy, I tell you, divorce is one of the bigger things that wrecks credit, leads to bankruptcy in so many ways, is because the finances are so interwoven with co-signing on mortgage loans, car loans, things like that. So the mortgage loan was issued before the divorce in most cases. It was issued with both of you there to qualify for that loan, regardless if the person had income at that point. They were on the loan, they were on the note, they signed the deed, they signed everything. So if the payment is not made, it reflects badly on the credit. Foreclosure can start regardless of who now is supposed to make the payment. So you can even have court orders, all kinds of stuff where people will say, well, I was awarded half the house, so I only should have to make half the payment. That's fine, but it doesn't predate the signing of the mortgage note, which doesn't get changed by that divorce decree. Now, the judge, you can go into there and try to change what's happening. I mean, it could go that far, but usually it goes way into foreclosure before that stuff starts to happen. So when you're on the note, you're obligated on that loan, regardless if somebody else is supposed to pay that payment. Also, if you go to sell the property, both parties have to agree. And if you go to refinance it, the other person has to be taken off. I mean, there's a whole process when it comes to divorce. So if you're going through that situation, you want to get started early before credit starts to be affected. If you have somebody that's awarded some equity, we have a lot of ways to be able to help you with that. But in most cases, almost every case, it's going to take a refinance. So that 2, 3, 4% interest rate that you got a few years ago, it's gone. You have to refinance to the new loan terms because you have to requalify with only one borrower and not have both of the borrowers on there or both incomes on there. Even if your spouse didn't make any income when you applied for the loan, that they were just on the loan because your husband and wife, you signed the loan, you signed the deed, you brought the property together, everything's great, honeymoon's great, and everything goes to heck in a handbasket and it leads into some sort of divorce for some sort of reason. So I help with this a lot. This is one of those things that it's just a natural process of stuff. I mean, stuff happens. So if you are going through a divorce or think that's going to happen and one of you wants the house and wants to cash out the other person or remove their name off the mortgage and title, I can help with all of that, but you want to start early. Too many times I have people that wait until they've got 30-day, 60-day, 90-day lates on car loans and mortgages and all this. And it just blows up the whole thing and almost forces you to sell the property. So the kids have to relocate. I mean, these situations are just ugly. Divorces are just, they can get really ugly. So before it gets that far and you have real estate involved, I'd love to talk to you about what the strategies are, what the ways to kind of save credit, save equity, save the property, all that stuff I can help you with. I even have investors that'll come and just cash everybody out, let everybody part ways, take your down payment, go buy something else. There's just a lot of ways to do it if you start a little on the early side instead of waiting until it gets really ugly. So if you or somebody you know is going through a divorce that has real estate, have them reach out to me, ryanbolton.com, and I can help you with options there. And you can post questions on the feed. Those should pull into my dashboard here. Let me move my camera out of the way here a little bit. Okay. And the lighting kind of changed because my little camera up here, the light went out. But oh well, I hope it's still okay. Looks okay. If you've lasted this long in the chat, if you want to write, "Hey, camera looks good" in the feed, that way I know. All right, here we go. Let's see. Can a house be sold without the permission of both spouses if only one is on the mortgage but both are on title? No. So the answer to that is no. So when you're on title, you're an owner of the property, even if you're not on the mortgages on the property. So neither party can sell the property without all parties acknowledging it or refinance or anything that has to do with that ownership, regardless of the mortgage itself. So the mortgage is a lien or it is a loan against the collateral of the home. It's not ownership of the home. So yes, if you have a husband and wife and the husband wants to sell or refinance, even if he's the only one on the mortgage, you both have to acknowledge it if you're on the title. So this probably ties into that divorce thing again, that they're trying to be able to sell the property and cash themselves out. And that's the whole protection of being on title, is to make sure that nobody can do something with the property without you acknowledging, signing the documents, or removing your name from the title so the person can then do whatever they want to do with it. So that is part of the protection of being on title, even if you're not on the mortgage. But in most cases, I don't know a single case where you can be on title or on the mortgage and not on title, but you can be on title and not be on the mortgage. Hope that makes sense. All right, let's see how else we're doing. How are we doing on time? All right, we'll keep rolling. We're having too much fun. Due to some financial issues, I need to sell my home. For the same home, I've taken a home loan and it's still running. How do I sell this type of property? So running, maybe that's a typo on there, but so again, you don't have to have the house free and clear to sell it. So as long as you can sell it for more than what you owe on the mortgage, so the mortgage gets paid off, anything left over, you would then get a check back for. You have to cover maybe property taxes. You might have to cover any past payments that are due or anything to pay off that loan, but anything left over is yours to keep. You might have real estate commissions. You might have title insurance, maybe a home warranty that you're covering. Maybe you're covering the closing costs of the person buying the house. But their money, whether it's a loan or them paying cash to buy your home, is what pays off your existing loan, and whatever's left over you get to keep. Now, there's a lot of moving parts with that. There could be, if you're short on covering, then you would have to bring money in, or you have to negotiate with the lender on what's called a short sale, where you're selling it for less than what's owed on the property. But typically, whatever's left over, they're still going to try to come after you down the road, or a collection or a judgment of some kind. Or you could even get a tax penalty. If the lender writes that amount off, it can show up as a tax bill to you. So hopefully in this situation, you will at least you owe less than what you can sell the property for. We saw a lot of that a few years ago. Well, no, it's been quite a while, where people were upside down. We're not seeing that as much. Most people have equity, at least enough to sell their property without having to bring extra money in. I mean, the equity usually is sitting there. All right, let's see. We've got some other questions here. I've heard about people leaving their... my dashboard moved. Okay. I've heard about people leaving their property and their homes and their animals. Whoa. I've heard about people leaving their property or their home, their animals, or sanctuary. How does that work? I'm not sure. I've heard about people leaving their property and their home loan to their animals or to something like a sanctuary. Okay, yes. So you can, this is where a trust is the best way to do that. So you can leave your property, leave that asset to your estate, and you can list anybody as your estate. There are people that have left their properties to their animals, and maybe even some of the money that's left over until their animal, to make sure their animals are taken care of. So yes, you can set up an estate. Usually a trust is the best way to do that, to assign what happens after you pass away. So a trust is really a way to have your signature or your desires extend after you die. And so you can say, hey, I want my house, my animals, my cats, dogs, horses, whatever you got. I want them to be comfortable and stay in this house until they pass away. So part of my estate will set aside money or set aside the value of the property to take care of those animals until they pass away or until they get assigned to somebody else. So you could say, okay, I want this dog to go to this person, that person, whatever it is. That's just really what a trust is designed to do, is basically carry out your wishes after you passed away, carry on essentially your signature, your wants past when you pass away. So yeah, you could assign the property to a church or a nonprofit or a sanctuary or anything you want to do. Once that death happens, then those things get triggered after that particular part. So that's kind of what a trust or estate planning will help you with those things. Good question. Is there a way to find out how much mortgage is left to pay on a house that is not in my name and only in my husband's name? We have had the house for 17 years now, and he is not telling me. Maybe again, this might be, I wonder if this is a whole divorce category. Maybe I jumped into kind of divorce real estate section here, but this is kind of sounds like some of those things you'd see in a divorce. If the house is only in his name, it's private information. I mean, just like you can't get access to anybody else's bank account or what they owe on the house or things like that. So there really isn't any way to know if you're not actually on the loan. So may ask him why. There's got to be a reason why he's not telling you. And maybe that's the question to start asking. But really, there's really no way to know that without committing identity theft by taking his social or something and pulling credit and see what the balance is. I mean, I've seen some people do that, and that's really, that's identity theft. If you go to the credit union, just give them your husband's social security number, date of birth, and pull a credit report, because then if he finds out, hey, how did you find that out? Then now you've committed identity theft. So there really isn't a way to do it. If you're not on the loan, if you're not have access to that account, then that's private information. And it should be. That really should be private information. Otherwise, anybody could do it. It wouldn't just have to be husband and wife. I could go down and say, hey, I want to know what my neighbor's owes on his house for whatever reason. Not that I care, but that there's those protections there for a reason. That right to privacy is definitely part of that. So if you're not alone, you don't have access to that information. But I would start saying, okay, why is he not telling you? Maybe he's borrowed against him. Maybe he's done some other stuff. There could be a whole nother things going on there. But unless you get somebody to pull his credit report so you can see at least what's reported on credit, you're out of luck. And even then, you're committing identity theft if you just go to the credit union and apply for a car loan or something like that and give them socials and then just take a look at the credit report. But that, again, you're committing identity theft if you do that. So not a good legal way to do that. Oh, wow. It muted it. Wow. Well, this system's very new to me, so I'm learning how it works. I thought it was just the little button I pushed on it, and I guess it somehow muted on the dashboard. Now, I'm using a system called StreamYard. Really do like it. I mean, I don't know what everybody else is using. If you're using something, put it in the comments. It's something that you've liked to use in the past. But I found this one, and it allows you to record or go live. This is the first couple times I've tried to do the streaming. It allows me to invite like guests, and I do all the stuff you see people on YouTube do. So I'm like, all right, well, give it a shot. It's called StreamYard.com. Okay, I want to quit my job immediately after closing on a house mortgage, then find a new job later. As long as I make the mortgage payments on time, will being unemployed cause an issue with the new mortgage? No, because once you get the loan and closed, you could lose your job whether you quit or not. So as long as the payments are still being made, you still get to stay there. So the underwriting's done, the loan is funded and recorded. You have to wait till it's done there. So definitely get your ducks in a row before you do that. But technically, no. Once the loan is funded, done, recorded, if you lose your job a week later or quit 2 weeks later, whatever it is, as long as the payments are made, they don't take back the collateral. But if you do that and then say, well, hey, I lost my job or quit my job right after I got the loan, I don't need to make the payment anymore, that's a whole nother issue. You've signed the loan, you're obligated on that debt, you're underwritten to that particular point. But the other thing is, I mean, if you know you're quitting your job before that and you claim nothing's going to change, I mean, there's some documents in there that probably get a little fishy if you kind of know ahead of time. So really, I would say make sure you have the other job lined up first. But stuff happens. I mean, yeah, people lose their job. I had one that they signed on like a Friday. Monday morning, we went to record, and they lost their job Monday morning. It was awful. I mean, just out of the blue, they just completely lost their job. And so that does happen. I mean, it's happened in our economy. I mean, stuff like that's going to happen. But if you already know you're planning on quitting, I mean, you're right on the edge of what you're basically falsifying the documents you're signing at closing by saying that things aren't going to change, but technically, yeah, as long as you make the payments, it doesn't matter if you've lost your job after you get that mortgage, as long as you don't miss your payments. Because as soon as you miss your payments, it doesn't matter why you're not making your payments. Whether you lost your job or not, they're going to start to take back the collateral. So hopefully that helps. Let's see. What does it mean when a lender says that they're waiting for an underwriter's approval? Okay, so when we first start the loan, we do an automated underwriting where it's this digital algorithmic type system where it takes the application, all the data and all the numbers on the application. We run it through that system. It runs it through a whole bunch of different risk analysis and all this stuff. Kind of kicks out what we call the DU or AUS or DO or LP, a couple different names for it, but it's the automated underwriting approval. And it's usually something along the lines of approved eligible. That's what you're looking for. You'll see sometimes approved ineligible because they can still approve it, but there's a few things you may need to tweak or adjust. Maybe down payment wasn't enough, or there's some little tweaks you can make to still get kind of that approval minus. It's not a full-blown kind of approval. Now, I can put anything I want on that application. I can put you make $1 million a month, and the approval will kick out. Yep, no problem. Then I get your pay stub or your W-2, and you make $500 a month. So that approval won't stick. So the underwriter's job is to verify everything, check the appraisal, title, homeowners insurance. There's all kinds of stuff that they're making sure fits the guidelines and rerunning that automated underwriter to make sure it actually matches the documentation that we actually get. So you usually have the automated underwriter run fairly early, usually during the pre-approval process. Once you get the offer submitted, you get it accepted, we kind of check it, make sure our ducks are at least close to what we think they're going to be. Then we get all the paperwork or verify all the paperwork through the inspection process, double check the findings again. But that's what we're waiting on, is that final underwriter approval, is to make sure what's on the application matches the documentation we actually have. A lot of it's verifying income, assets, insurance, title, appraisal. Those are a lot of things, but even an appraisal report's 20 to 40 pages that the underwriter goes through and say, hey, is there any issue with the appraisal? They'll look at the photos and say, boy, that roof looks like it's caving in. Do we need to address that? Or if the appraiser makes a note and says, hey, the water heater wasn't working, or foundation looks like it's cracked, or the roof's in trouble, or visual water damage on the sheetrock, or they'll note some things that they notice as well. And then the title report, they have to review that and say, are we really selling to the right person? How many liens have been on the property? I mean, there's guidelines for everything. And so the underwriter's job is to go check all the guidelines with all the documentation we have. Then they will typically issue what's called a conditional approval. That says, okay, I've looked at everything, I've cleared everything I can, but now I have questions on their income, their job history. I have questions on the W-2s, like there's a missing W-2, or the W-2 doesn't match, or the homeowner's insurance, I don't have a copy of the homeowner's insurance, need that. Or so you usually get a list of what's called conditional approvals. Then you go out and get those conditions, you get them back, they ideally sign them off in one shot. Oh man, mortgage people are just going, yep, ideal. This is ideal. This is what world are you living in, bud? But I mean, this is just how this all works. I mean, there's nothing hidden. There's nothing like sneaky behind closed doors. They're all man-made boxes and solutions and checklists and all this type of stuff. But there's names for this stuff. So you'll get the conditional approval. Once that's approved, you get the awesome, glorious, clear to close. This is saying all the conditions are met. They're all signed off. Everything's been checked. Now it can move on to the doc department that'll actually issue the documentation. Now they'll go through it, and sometimes they'll catch a little thing. Maybe the insurance has the wrong address. Maybe they'll see when they go to invoice for the appraisal, or there'll be little things that they can check as well that can get caught. Then the loan documents go to the title company. Then they get signed. Then that file goes to the funding department, who actually orders the wire, balances everything, funds and records, and then you get your keys. A lot of that's happening in the background. You don't have to worry about all that. That's what you have me for. That's what you have the title company for. There's all these people that are working behind the scenes to make this as smooth as possible, but stuff pops up. Or you'll get that conditional approval list. You'll send in the condition and it doesn't quite get what they need, or trigger something else, or so that's why I always try to find out the why behind the condition as much as possible, so I can explain to you what we need to get. And sometimes it's a little different than the condition. Like almost every time I get, okay, we need this and we can't get it, but there's a why we need it. So we say, okay, we'll go get something else. And sometimes you turn that in and it doesn't quite fit again. So then you got to go back and forth. So there is a little bit of that where people, get their conditional approval, send the conditions in, they think they're done. Like, I don't have to worry about anything. And then a new wave of conditions comes back. And sometimes that can be a very frustrating process. And I totally get it. But there always is a why. There's always is a why. And if you understand that, getting the what can be a lot easier. But getting that clear to close, I just had one yesterday. Was it yesterday? Maybe, what day is it? What day are we? Thursday? Man, I think it was Tuesday. Oh, it was great because we were fighting that file forever. You know who you are out there. I am so happy for you that we got that done, because it just was not fitting and had to get paperwork. The paperwork we got wasn't quite right. We had to fax to get some stuff cleared. I mean, I think I left my fax machine in 1996. That's a bad joke. But you know what I mean? So, I mean, stuff happens. It's just man-made problems have man-made solutions, but sometimes there's just problems getting stuff. But that's part of my job, is to try to smooth that out as much as possible, catch it ahead of time, get the paperwork ahead of time so the underwriter knows about it, explain it ahead of time. Just that way it goes so much smoother. Are we perfect? No. There's stuff going to happen. I've messed up. I've done this way too long to say I've done it perfectly, but I have seen and done it all. And so I have at least a chance to be able to head some of this off at the pass, or just get it early, or just realize that's going to be a problem. We're going to have to deal with it. Let's see if we can clear off everything else, but that's going to be an issue. And either other times we get stuff into underwriting to get us a full list. And we know we need to get X, Y, and Z. Let's get it to the underwriter, see what else we need to work on so we can get all one final list, get it in, get it closed. Everybody gets their keys. Everybody gets to move in. Happy days, that type of stuff. So I hope that answers that question. That might be soapbox number 4 on this live stream. But it's my world. It's the world I live in. So welcome to the world of mortgage financing. What are the consequences if I'm unable to sell my house and still owe money on it? What are the consequences if I'm unable to sell my house and I still owe money on it? Well, if you don't make the payment, you're going to lose the house. Hopefully you can sell it for more than what you owe. If not, you're going to have to talk with the lender about what's called a short sale, and allow them to agree to at least release the lien so the new owner can put their lien on it, or ownership, transfer that ownership. And if you're short, you'll have to work out something with the lender. That's where you'll see bankruptcies filing. You'll see all kinds of different stuff. You want to check if there's mortgage insurance because that usually offsets some of that as well. But if you don't make the payment, you're going to lose the house. Even if you lose the house and they don't sell it for what you owe, they can still come after you for the difference. That loan was signed. That was the obligation. You signed your name on the loan. This was collateral for the loan. Those payments are still due. That's how financing works. No pay, no stay. Here's a longer question as well. I'm trying to pre-read it to make sure I can understand a little bit. And I'm doing this live. There's not any pre-screening. I'm just trying to live off the cuff. So if you have a question, I'd love to have you jump on there and post a question. I can answer that for you as well. But let's jump on to this question here. My house is paid off. I bought a second home with a mortgage that we could afford. Should I rent or sell? If I rent $25K or $2.5K, $2,500, it pays for the new house. If I sell, the new property will be paid off. Well, yeah, when you sell it, the property is going to be gone. So, that is completely up to you. I mean, you got your house free and clear. You bought a second house with a mortgage you can afford. Should I rent or sell? I wonder if he's talking about the old house or the new one. There's a lot going on with that question. I can't really answer it. Oh, I guess he's saying if he pays off or if he sells the other property, would pay off the one they just got. Yeah, but then you get the rent at $2,500 a month plus the appreciation. So it's just whether or not you want to be a landlord, whether the properties are fairly close, if you want to hire a property management company, just maintain that type of stuff. I have rental properties. I don't have a problem having rental properties, but there's pluses and minuses with that. There's times where you're going to have renters that are gone or don't treat the property right, or you'll have vacancy rates, or you have repairs you have to do and just stuff like that. But I'm a big believer in real estate, and I've been able to kind of grow that portfolio because of some of that rental properties that I have. So it's whether you want to be a landlord or not. But just paying off the mortgage, even if you get all that money, I don't know if I'd pay off the mortgage, because if you get that lump sum, you can pay off all the other debt. You can put money away, retirement, savings, emergency fund. You can use that money you get to make the payment for the next 10 years instead of giving them all the money right now. Why not just spread it out over the next 10 years? So there's lots of ways to make that work. So that's what I would say. This leads to this next question. If you do have money from selling a home and you're relocating to Utah, or you're downgrading or upgrading, whatever you're doing, you've got some equity to work with, I don't recommend taking all of it and putting it down on the house. There is a sweet spot of the right amount of money down versus getting rid of any other debt, putting money in savings, diversifying that down payment. Because once you put it down on the house, the only way you get the money back is selling or refinancing. And so having it more liquid, having it more investment savings, more of a strategy behind it is a way better thing than just assuming you've got to put all the money down. Well, I want to get rid of the mortgage payment. Well, if the mortgage payment was gone for the next 10 years, but you still had $100,000 in the bank and all your other debts were gone, what's a better solution? And people sometimes just goes over their head. They're like, deer in the headlights, I don't want to deal with all that. I don't want to deal with all that. So I just want the mortgage gone. I don't want a mortgage payment. I don't want a mortgage payment. I get it. Totally fine. But I can show you some strategies that can do both, that you can be your own bank in the future. You don't have to go get a refinance or sell the property to get access to the equity. You've already got it. You can use it to make the mortgage payment. So you can become your own reverse mortgage in a sense. So there's just better ways to use that money than putting it all down. But there's a sweet spot. There is a magic spot that works for people based on the other savings they have, their other debts, their other retirement plans, their other modes of making income that need to be considered. There's not a one-size-fits-all. And it's definitely not everybody should take all their equity from the selling of a home and put it all down on the next house, or even pay cash for the next house. There's ways to do it that are so much better, way more strategic, and way more of a financial plan than just another mortgage loan or another house. So if you're in that situation, I'd love to help you with some of the numbers to be able to make sure you're maximizing the programs that are out there. All right, let's see what else we got. We'll just go to the top of the hour here. Let's do that. So if you have any questions, please post in the comments. Let's see. Let's go into, let's just go real estate for a second. We kind of been doing a lot on mortgage. Let's just jump into real estate itself. Very first question, is it worth using a real estate agent or should I sell my home myself? I think I saw Washington County probably is not this number. I thought I saw somewhere like 50% of all homes are for sale by owner. That seems high to me. It seems like a way bigger percentage, especially in Washington County, are not for sale by owners. But I think also some of that numbers could just be family members transferring properties, and that's considered a sale or a transfer, even though it really isn't a sale in the traditional sense. So I don't know how much that number is hard to track. But I would love to know. I have to talk to a title company and get an idea what actual percentage of homes are sold using real estate agents. But it's not 100%. It never has been 100% where real estate agents sell every single home that sells in Washington County or in any county across the country. So here's a couple things I would say. The real estate agent, there's a lot of things they bring to the table. They're going to bring expertise. They're going to bring marketing. They're going to bring listing on the multiple listing service, so all the other agents know about it, so they know what's there. Descriptions, photos, staging. There's a lot of that stuff that they're going to do. And it's really getting the right real estate agent. So is it worth getting a real estate agent? Yes, there is really good agents out there. I would say more times than not, you're way better off with a real estate agent. And here's also another reason. If you have it listed for sale, it's amazing how many buyers will go, well, they're not using an agent, so I'm just going to reduce the price by the cost of an agent anyway. So it's really weird how often you're going to pay that reduction in price or that real estate commission without having the benefit of having the real estate agent. I mean, think about it. If you saw a for sale by owner house on the corner of the street and they were offering X amount, there's this sense that, okay, well, I can take this much off the top, or I'm going to offer less. It's right off the bat. It's amazing how often I get first-time home buyer, or not. I get for sale by owner properties that my clients want to buy, and the first thing they do is say, well, they're not using an agent, so I'm going to offer less. It's crazy how often that happens. Well, then you say, well, I'll just build it into the price. I'll just raise it up even further. Sure, but then you're competing against what else is out there. You're also not going to get exposed to as many other buyers without using their systems. They're really the gatekeepers in so many different ways. And having that representation can be worth it. Now, there's negotiation. You don't have to, you can talk with the right agents, see what they're willing to do with their commissions. You can structure it in certain ways. There is great real estate agents out there. So I would say, is it worth using a real estate agent? Yes, the right one. This is not for all real estate agents, but there are really good ones. And that's where I can help you with referrals. I've been doing this for 20 years in Southern Utah, 26 years. I've been loaning money with real estate. I've done it since 1999. And so I've worked with a ton of agents in town and know which ones are working in better areas, which ones are worth it, which ones are negotiable with commissions, that type of thing. And I can really help you narrow that down. But you can also get referrals. You can check with title companies. Title companies like First American Title or Infinity Title on Tabernacle, Terra Title, Southern Utah Title. I'm missing a bunch of them. There's a whole bunch of them I've worked with in town. So if I left you off the list, I'm sorry. But you can talk to any title company. They also work with agents, both on the buyers and the seller side. They work with loan officers. They can give you a real good idea of who more like who to avoid, or they're never going to really sit there and bash anybody, or hopefully they don't. But they're going to give you a good idea. Okay, yeah, good agent, bad agent, how many transactions they've done. They've done a really good job. They get to see the makeup off. They get to see behind the scenes, because they're dealing with them on the title report and the mortgage loan and all the other stuff. So you get kind of a behind the scenes baseball a little bit when you talk to title companies. So, but that's where I can help. That's part of your team, is to help you with the right agent, help you with the right listing, that type of thing. I think most of them are worth it. There's going to be some that aren't. There's going to be some that charge way too much. There's going to be some that don't advertise or market and do all that kind of stuff. But I would say I use agents when I sell my houses, because of the exposure, the professionalism, the negotiation, I can do a lot of that, but I still choose to use real estate agents. A lot of it for the marketing, and just make sure that the professionals are involved on that part of the transaction. So I would say yes, real estate agents are well worth it. All right, let's see. Any other questions? Let me check the dashboard here. You can post a question on either Facebook or YouTube. This should be posting to both. So I put the link on my YouTube channel, which I'll pop that up for a second right here. You can go to YouTube /@Mortgage Nerd. So that little N3RD is just kind of a fun way to say nerd, kind of a gamer tag kind of thing. And it was available. There's a bunch of like mortgage nerd variations that were out there. So I just kind of came up with a fun little way to say 3. And you can see I had a hat in one of the streams. It was just kind of a backwards 3 for the E. Just kind of a fun little play on words there when it comes to nerd. So you can check that out on YouTube. I post reels and videos and shorts and and market updates and all that fun stuff. A lot of Q&As. I like to do the Q&As because I think it interacts with people the best. So check that out. Let's throw this up here as well. This is my Facebook page. This right here is my QR code for my mobile app, which has great mortgage calculators on there, all kinds of different tools to help you with your mortgage financing. So I'd love to help you with that as well. But you can post a question, and I can answer that for you. Let me just remove that. Okay, cool. This is a cool little system called StreamYard. I like it because it's one dashboard, hopefully one dashboard, that I can post to any different socials. So I have it on Facebook and YouTube. I haven't really tried it with like Instagram, or I don't really have a TikTok, and I don't know if I can do that with this system. I think it had a whole bunch. Some I haven't even heard. I think Rumble's on here. I've never done anything with Rumble yet. Man, there's so many to try to keep track of. But Facebook and YouTube is where I do most of my content creation. So let's jump into some more real estate questions for the next, we got about 9 minutes, kind of go to the top of the hour here. How does a flat $5,000 realtor fee model benefit both experienced and first-time home sellers? Again, I think it comes down to the agent. It comes down so much more to that. There is a consensus that the flat agent fees are doing the bare minimum, just listing on the MLS and doing that type of stuff. You have to kind of handle a little bit more on your own. But I've still seen some flat loan officer fee models that are just fine. They're doing enough volume that they've got a really tight system. So much of it comes down to the loan officer you're using, the mortgage company you're using isn't as big a factor as the actual loan officer, the guy pushing the paper, the guy or girl filling out the contract, that's showing up for the listing, the open houses, that type of stuff. It's a people business. It's a sales business. That's who you're interacting with. That's who you should be hiring. The name behind me, Patriot's great. They do a lot of stuff. I really enjoy Patriot. Great ownership group. Love this company. But really, you're using me for the loan. The buck kind of stops. I'm the one that ends up screwing it up or helping. So that's where the person you're hiring matters a little bit more than maybe necessarily the fee structure or the logo behind them or that type of stuff. That's who you really want to interview, and that's who you want to make sure you have as much confidence as possible in who you're choosing. That's where I'm doing these podcasts. That's why I'm doing these shows, is to just earn your business, show you that I'm an expert, passionate about this. I've been doing it for 26 years now. I've seen and done it all. And I just still love the problem-solving aspect of the business. And so I want to earn your business. If you're trying to finance a home, you need money for a house, whether it's home equity lines of credit, investor, private money, bridge loans, reverse mortgages, construction. All of that stuff I can help you with because I sell money for a living. That's really what I do, is I sell money for a living on real estate. I can do a little bit of commercial as well. So if you have commercial, I don't do as much with commercial. A lot more of it I do with residential. But I'd love to help you with any financing needs you have, refinance, purchase, home equity line of credit, going through a divorce, family, trust, will, estate, the kids got awarded the home, they need to cash it out. You name it. Bring it on. I can handle all that. So I'd love to earn your business. Let's see. We got about 5 minutes left. Let's round out with one final. We got to find a great one here. Excuse me. That one's pretty, that may take a little more time. I want to sell my house. Oh, wait. I want to sell my house, but it has another owner. What are my options? I want to sell my house, but it has another owner. They have to agree to it. If they're an owner, just like you, if you are an owner and you have somebody else that's an owner, so husband, wife, brother and sister, friends, whatever it is, you got two owners. You wouldn't want them to be able to just sell the house without you getting acknowledged or at least signing off on it or agreeing to the paperwork or seeing where the funds are going. That's the protection of being an owner, is that somebody just can't sell your property. So if you want to sell your house, the other person has to know about it. That's how it works. And that's how it should work. That really is how it should work. For better or for worse. Till death do we part. That's usually what you see with those questions, unfortunately. Is it some sort of divorce situation where they want to sell without having to let their ex-wife, maybe they moved out, they're paying alimony and they have some sort of ownership stake and they're supposed to be paid half the equity and they're trying to get around that. I'm not trying to make assumptions. I've been doing this a long time and I've seen the worst side of some of that stuff for sure. But if you're an owner of the property and the other person tries to refinance, sell, add a lien, none of that can happen without you acknowledging it. Part of the title insurance's job is to verify ownership, verify lien positions, and offer insurance to make sure if that does happen to slip through the cracks, the insurance is actually what covers that stuff. So their job is to find that. If they see another owner, that other owner needs to be at least acknowledge what's going on, sign the paperwork, sign the warranty deed to take their name off the property or whatever's going on. So I want to sell my house, but it has another owner. What are my options? Tell the owner you're trying to sell. That's it. They're an owner. They own. It's not like you own 50-50. You both are 100% owners. So neither one of you can do anything without both people acknowledging it or being removed from the property. That is probably a good one to end on. We've got about 5 minutes left here. Let me just make sure I didn't miss any questions on the feed. Thank you for those that jumped in. Let me just make sure that, okay, yep, shows everything is live. Very cool. Oh, look at this. There's a button I didn't see before. Oh, look at this. Oh, wow. I can actually view it on YouTube. Oh, that's cool. There's a slight delay, it looks like, but that's okay. That's cool. This is called StreamYard, StreamYard.com. I don't know if you guys use anything different. I've just been playing with the system. It allows you to kind of record and go live. This is, I think, my second, maybe my third now. I think it's on my second one with this system going live. But it's kind of cool because I can record it here and then but post it on both YouTube and Facebook. And it looks like any comments that come in all come into the one dashboard. I can invite people to join the presentation. I can throw up these slides. I mean, I have no frame of reference to know if this is any better than anything else, but so far, every time I kind of play with it, I've really enjoyed it. I've been creating some of the other YouTubes and other podcasts, and it can just do the recording too, so it doesn't always have to be just the video, which makes it nice if I just want to jump on and do like a quick podcast or something like that. But excuse me, I'm losing my voice after 2 hours of talking. So my wife will be surprised. She's never heard me lose my voice once, right? Yeah, I'm a talker. I'm a talker. You know what? I got something on my desk. That's 2 ears, one mouth. Slow down. I know. I know. It's right there on my desk. I need to maybe put it closer to my monitor. But I like doing what I do. I've been doing this for so long. It's got its highs and lows. I went through 08, going through whatever this is, with the slowdown of the mortgage industry and rates being higher and everybody waiting for the crash or waiting with this is the new normal. And I've been saying for a while, it's like the people that are waiting for the crash are the people in the lower price ranges. As soon as rates get better, then all of a sudden there'll be 100 people that can afford that one home in that price range because they're not building a lot in that price range. And there's not a lot of existing homes going on the market because they can't replace their interest rate. So this whole idea that everybody's waiting, you're going to wait yourself right out of the market. And if a home hits the market that fits your needs, fits your budgets right now, buy the thing. You can always refinance rates if they do get better, but you won't be able to get that lower price. And you're going to have a housing expense. Whether you own or not, you might as well own it. There's just so many more benefits to own the home than renting. Now, I know there's hurdles. I know the prices are hard. I know interest rates are higher. But waiting to time interest rates in the market is almost impossible, even for the experts. That home ownership's designed to be a long-term, winning in the long run kind of thing. It's not designed to be just a quick, easy kind of thing. It never has been. There's moments where that's just happened. There's moments where you can time the market. But I'm telling you what, you're going to have a housing expense either way. If you're waiting for interest rates to go to 5%, what are you paying in rent right now? Like 108% when you figure you're not getting appreciation, you're not getting the tax benefits, you still have that housing expense, you might as well own it. Now, maybe you have to team up with a friend or a family member or something to kind of buy that first house because to afford the house that you guys want and then sell it in a couple of years. You're still going to be better off than both of you renting some other house for $1,500 each or something. So even if you have to team up on a cosign thing, there's options. You're not going to wait out the market because if interest rates do get better, how many more buyers show back up? And the supply is not going to just shoot up if interest rates go down. It's always going to lag behind that, especially existing home sales that aren't hitting the market. So it's much more about getting pre-approved, finding out what you qualify for, and then finding a home that fits the budget. That's it. And then buy it. That's it. It's not harder than that. You're overthinking it if you're trying to wait for some magical interest rate or waiting for some big housing crash. Because even if there is some sort of correction, it's not in your price range. It's going to be that $1.5 million home that's going to go to $1.4 million or $1.2 million or something like that. The $300,000, $400,000 house range, there's way more buyers always in that category, so you're not going to see that price range just tank and go way down. You're just not. Now, there's local things. There's stuff that can happen, sure. I'm not going to say that some place that's reliant on one industry and the industry goes and the whole town turns into a ghost town. I mean, I remember seeing something in Washington, D.C., like how many homes hit the market was nuts because there's so many people losing their job and Doge and all that stuff. So there's just a huge influx of homes hitting the market. With so many homes, the prices really had to go down to get the ones that were more desperate to sell. But that's very localized, and that's what real estate really does. And Southern Utah has so many things going for it. It's going to be a growth community for probably 20 plus years. And they're going to have to build most of that growth because existing home sales are so low because people only owe $300,000 on their house at a 3% interest rate. So now they have to go to $600,000 and a 7% interest rate. So that's why you see existing homes are harder to find. So if one pops on the market, jump on it. Don't worry about the rate as much for today. What's the payment today? If that works, the payment can always get better if rates get better, or if rates get worse and home prices get worse, you're locked in at that lower payment. And the payment's way more consistent on a mortgage than it is on a rental property. When was the last time your rent didn't go up? There's pretty rare that every renewal doesn't have some sort of an increase because rents go up, cost of stuff goes up, utilities, things are covering, homeowners insurance, those stuff go up. And so the rents and the cash flow has to go up as well. Boy, there's soapbox number 5 tonight. But I appreciate you watching. I don't know if you end up watching this live or if you watch it later on my YouTube channel. But I appreciate it. I love to earn your business. I do lending in Utah and Nevada. That's why I do this channel, is to be able to just show you my passion for this, to answer your questions. I really want to help you with real estate. Whether you're buying your first house, upgrading, if you have an existing property that you need a bridge loan for to cash out that equity, I do a lot of those types of loans. So I often say I sell money for a living for real estate. So if you're going through a divorce, if you inherited a property, if you're trying to buy a house with a kid, anything that deals with real estate and financing, I want to be your guy. Go to ryanbolton.com. Let me post that real quick. Let me add that to the stage. Go to ryanbolton.com. There's the QR code that you could scan for our downloadable app. It's got mortgage calculators on there. You can contact me, scheduling, all kinds of fun stuff are on there. Or check out ryanbolton.com. But I'd love to earn your business. I appreciate your time tonight, and we'll see you on the next stream. Have a wonderful night, everyone.